Good morning, everybody. Welcome to the Flow Show. Friday, NFP Day, Jobs Day all over the place. Canada as well. Going to be a nice, busy one, hopefully. And then we can all sail into the weekend. Morning, Kay. You got your sails up?
Good morning, Ryan. Good morning, everybody. Yep, absolutely, man. Excited for the last few hours of the week, and even more excited for the weekend, to be honest.
Yeah, well, it seems to be the case, doesn't it? As these times, yeah.
Time flies, but there's a lot going on every week.
Yeah, it seems like it's time is just sort of running like water at the moment.
It's impatient.
Yeah, I don't know. It'll be soon Christmas, and then we'll all be moaning that it's the new year again. Anyway, plenty more to do before we get to that. Let's crack on. Japanese Finance Minister Suzuki out again, declining on whether they intervened in FX markets. Now, a little bit of headline football going on here. Bloomberg reported him saying that gradual one-directional moves could be excessive. He has been talking, they've all been saying about watching with a high sense of urgency against excessive moves, blah blah blah. But there's a few more comments coming out about what excessive moves mean. A lot of people thinking it's volatility. Well, that's not quite the case, it seems. Kanda, out in his comments the day or so ago, also emphasised this, saying that if currencies move too much on a single day or a week, that's judged as excess volatility. But even if that's not the case, if we see one-sided moves accumulate into very big moves in a certain period of time, that's also excess volatility. That's something I brought up the day after intervention, just looking at the dollar-yen chart over a long period, as to whether perhaps they saw this move since the early part of the year as being excess volatility, or whether that's the reason they've got panicking. So it seems like that could be the case just from these recent comments. It's no real big deal for us sitting here right now and what to do with dollar yen, but it's just, again, a little bit of insight perhaps into their thinking, whereas before we were looking for volatility and speculation to come into the jawboning. Well, now it seems they're looking at the grind and the moves over a longer period, which also tend to think that maybe it is the level of the yen perhaps that they are looking at, because this has been going on for quite some time, this move. So why not intervene when it got to 145? Why not intervene when it got to 148? Maybe the level is important, but as I say, just a bit more insight into their potential thinking. If this does grind higher, it still keeps us in intervention risk, rather than if that blew 200 pips and then they intervened, sort of thing. Anyway, that's my thoughts on that. You got anything to add to that, Kay?
Yeah, the thing is that it does seem that since Corona has gone, that well, I mean, Corona said the famous 200-300 points per day, right? And we know that from the past, historically, they were looking at the volatility, and at the same time looking at where the dollar was going versus the yen, versus and against where other pairs were going. It does seem that they evolved just a little bit from that, but it is undeniable that dollar yen moved up since the interventions of last year, where we hit somewhere around 127.5. It is true that dollar yen went up like 22 big figures and the 23 big figures from those lows. So that is for them a big move. And I just want to reiterate, even though he couldn't keep it in those ranges, because we had the Asian crisis and everything, and LTCM breaking up in those years, but Sakakibara was already a guy back in the 90s saying that for him the range of dollar yen was 125, 145 in those days, and they did intervene as well when we went outside of those ranges. Okay, events have made that they could not protect this range for very long. At least the top side they could, but the bottom side not. Yeah, it does look like they are going back to more a spread over time approach than really the day-to-day accelerations that we thought were at the order. So it also seems that because we haven't heard anything about this famous speculation line that they used for many years before intervening, it does seem that they want to hide stuff a little bit more from the markets. Perhaps they thought that they were a bit too transparent for too long. So we're going to have to take into account all of that and gradually adapt the way we look at how they approach the markets, right?
Yeah, exactly. Looks like they're spicing things up a bit, shaking the apple cart, as you like. Right, but anyway, moving on from that, we did get some data out of Japan overnight, the labour cash earnings, just to give an insight on what's happening with wages and stuff over there. A little bit softer year on year. Hasn't got the full. Has it got the full numbers here? No. So it's got well, the real cash earnings there. Well, it's got household spending there down 2.5%, not as much as expected. It's not showing there the other numbers. So there's the leading cash earnings. The real cash earnings, so taking inflation and whatnot into account, was down 2.5% versus was minus 2.5% versus minus 2.1% expected. The prior was minus 2.7%. So real cash earnings coming down. That's something that Kishida wants to get turning the other way, but obviously inflation plays its role in that as well. But I said household spending number down on the year, but healthy on the month as well. So the wages front, it's still an ongoing saga, and it looks like there's going to be some inflationary pressures coming through in October. Kyodo had a piece out a couple of days ago saying that there's going to be some price rises coming into a lot of goods and services in Japan in October, which is likely to, as I said, bring another inflation push on top of what they're already seeing with higher gasoline prices and the like. So October's data, which we won't get until November, is potentially likely to see some higher numbers, or at least it's staying sticky, depending on whatever else it does. So it's saying just to keep an eye on for next month, stick it on your post-it notes or whatever. MUFG Bank Chief says that the BOJ could move to end negative rates as early as January, but will probably have to maintain YCC to avoid any abrupt rise in long-term rates. Sorry?
That's funny, that one, because it's quite the opposite, that most BOJ watchers are thinking that they're first going to leave the YCC and then start to raise rates. So MUFG takes the opposite path. And also they were also saying that they were very worried about the Japanese fiscal situation. That doesn't make our job much easier.
No, exactly. I mean, I suppose, looking at it logically, if they are going to bring rates to zero, it depends on how they sell it. If it's just ending negative rates rather than entering a hike cycle, that's a bit different. But maybe they do have to keep YCC in play just as a sort of tool to keep volatility down, to stop bonds blowing out. Although, they can still just keep doing what they're doing now and stepping in when yields rise. But who knows? They're pumping anyway, early as January. We don't know if it's going to be January, March, Q1, Q2, whatever, potentially. But we'll keep an eye on that inflation number, because that's the one that's potentially going to be the biggest kicker for what they do later in the year. The RBA, they were out with a financial stability review. I won't bore you all the details. The main line from that was that most borrowers are well placed should rates rise further and can cope with extended period of high rates. So that's the financial stability side, saying that potentially if rates have to go up, then it's not going to be too much of an issue for borrowers. So it gives them a little bit of wriggle room if they did want to raise rates. As I say, that's a financial stability viewpoint there rather than a monetary policy one. ECB's de Guindos, it's premature to discuss rate cuts, keeping up with the guidelines there. ECB's Lane says bond market pricing shows the ECB rate gradually going back to 2%. It's not so rosy in Germany. Bundesbank head Nagel says the inflation fight has not yet been won. High core rate is worrisome. Colleague Schnabel, if risks materialise, hikes may be needed eventually. She still sees risks to rising inflation. ECB's Vilroy says an increase in bond yields may be excessive, but it is helping to tighten financial conditions. And he says, I don't think an additional rate hike is justified now. BOE's Broadbent said clear signs that rate rises are having an impact, and the UK is seeing weaker demand and higher joblessness. Coming over to a bit of data into today, and we got some numbers, where are they? From German factory orders, which showed a pretty decent rally on the month, up 3.9% versus 1.8% expected, and far better than the disastrous minus 11.3% we saw last month. Year on year wasn't too bad either. Not shown on that calendar. Year on year was down 4.2% versus minus 7.9% expected and minus 10.1% previously. The German government is out with its latest forecasts for growth. They now expect GDP to decline by 0.4% in 2023. They see 2024 growth at 1.3% and 2025 at 1.5%. Kicking back to yesterday, we've got a little bit of jobs data from the Challenger Grey numbers, and in initial jobless claims, that's the word I'm looking for. So Challenger jobs, 47.5k job cuts cited for September, down from the 75 previously. The tech sector and retail sector are still leading the way this year on those losses. As we know, there's been big cuts in the tech sector, and that's continuing as well. I think Meta is going to be announcing some job cuts as well, coming up soon, so that's going to feed in. But then jobless claims still all looking tickety-boo. Only a 2k gain over last month, lower than expected. So still there's no real signs coming in that there should be any worries about today's NFP. But I will repeat that it is still a complete lottery. Even with all this good news and suggestion that things aren't bad, you could still get a minus 300k number if that's what's going on. Such is the nature of this report. But it shouldn't happen, but you know, I've seen it happen before, we've seen it happen before, so always expect the unexpected. On the trade front, a little bit better on the trade numbers there on the deficit, coming in at 58 point minus, or the deficit was 58.3 versus 62.3 prior. On the activity front, looking at those export imports, I give you the dollar values there, but exports were up 1.6% versus 1.7 prior. Imports were down 0.7% versus a positive 1.7% prior. So no real big activity moves there. You know, not seeing big negatives in both counts or big positives in both counts, imports and exports, like we've been looking at for other trade balance data. So again, it shows that activity is holding up. Nothing really that's shaking any trees or getting anyone worried. And as said, an improvement in the dollar amounts as well. On that front, Fed's daily says we can hold rates steady if labour and prices keep cooling. It's possible the slowing so far will translate into steady march towards our goals. There are real risks in inflation projections, and we'll need to see progress on super core inflation to be confident we are on the path to 2%. She suggests if yields remain high, there's no need for another hike. So pretty much to say a similar comment to Vilroy about high yields doing a bit of a tightening job for them. She did say we are going to start seeing more dispersion in the dot plots. I think that's a fair enough comment. As we get into next year, we might get a few different opinions on where rates should be sitting, depending on what the economy is doing. The market odds for hikes in November and December don't look out of line. Now, the US auto sector is facing more woes. Apparently, there's some issues with airbags, and some 52 million vehicles are going to have to be recalled to have those fixed. GM apparently has at least 20 million of those that need fixing. So coming on top of problems with strikes, bringing things to a halt in the auto sector, they're now going to have a big outlay, or the sector itself is going to have a big outlay in fixing all those airbags. So it's not what you need. It's long and short, it's a big cost increase to both paying higher wages, forking out for this stuff into a potentially slowing economy. It's not a good sum for this sector. So this may be something that we need to keep an eye on, because it could have the possibility of impacting activity, seeing it in jobs as well. You know, if they're shelling out a lot of money, not making the sales, the first thing that gets chopped is workers. And then it's going to impact GDP, and it's going to impact spending, so on and so forth. So just another bit of bad news for the auto sector in the US. Now, this might be a thing, it might not be a thing. It's probably not a thing, but it might be a thing. The press reporting that Biden is going to deliver remarks on the jobs report at 11:30 Eastern time. I think that's like 3 hours after the jobs numbers. Now, two things. We know he gives economic updates as he likes. This one has been reported as remarks on the jobs report. So I don't know if that's the press just spicing things up a bit, trying to do a bit of clickbaiting, but maybe the market will start thinking, well, why is he speaking specifically on jobs? Does that mean it's bad news? We're going to get a horrendous number and he needs to come out and fight the fire? Or is it going to be another stonker of a report and he needs to come out to tell everyone how great he is, that he's making the US economy tick along? As I say, it's probably nothing, likely nothing, might be something, who knows? It's 3 hours after the ADP anyway. So what it might do, as I say, might get a few people coming into the US thinking, oh, why is Biden speaking? And then they get all a bit frothy about the NFP. Right, that's it. Kay, any thoughts on that or anything else?
Yeah, I don't think it's a surprise. As I said this morning in the room, he's been talking about after several reports in the past. So I think it's just the media perhaps trying to make something about it. I'm actually not surprised at all. It all started with Trump in the days, right? And Biden has made a bit of a habit of talking on the jobs report after it comes out. So I'm not surprised at all. I don't think it means much, but if people want to read something behind that, free to everybody, of course, to make a deal out of it. Yeah, while you're on those data, I just want to highlight the Swiss foreign reserves coming out. You're just in the middle of your screen there. It continues to come off. So since October 2022, which is around the time, if I recall correctly, or September or so, when they said that they were going to hike rates, but especially use the Swiss franc to fight. Yeah, we don't see it on there. You've got to go on Trading Economics, the page, if you want to look at the evolution of the S&P reserves. It's a massive decline. they went up to, over the pandemic, they went up to close to 950, 940 billion Swiss francs equivalent, and they've dropped now to 678. That is a very big decline, and that really, and it's September data, so they are pretty fresh, and that means that over, there we go, and that means that over the course of the past month, their FX reserves went down for another 16 or so billion Swiss franc, and looking where Swiss franc is trading, that's another 18 or so billion dollars equivalent. So they still have been on it. Now, is it the first part of the month, or is the last part as well after their meeting? We don't know that, but we don't have weekly data, right? But it seems that they are still not letting it go. And that that is one that I'm keeping a really, really close eye on when those numbers come out, because if at any time that stops going down, it likely means that they say that they are at levels where it's okay, which is something which I highlighted as well in our room, is that they even are below 2018, 2019 levels already. So they did not only sell all the pandemic stuff out, but they even went below. So this still testifies that they are fighting very, very hard against inflation via the value of the Swiss franc. Okay, so that is one that I'm really keeping a very, very close eye on. As I said, if it stops, it may be a signal that they are happy where things are. And by the way, the inflation, depending on the metric, is within their 0 to 2% target zone, albeit at the very high side. So that's the other thing I picked up this morning. And for the rest, you've said most of it. Is there something in the UK going? Because I've read a couple of things, and I would like to ask your opinion about that. Is there something going on about Labour, Tories? Because now I see that the Labour won some by-elections there, but it's very small stuff, but it's apparently significant because it's the first time in whatever how many decades that they won this by-election there. But then I see the press now all of a sudden starting to change tack a little bit. We have this pre-concept in the markets that whenever a Labour report comes on, it's more spending, it's watering down on the finances, sterling gets sold off, right? Now, apparently, the press is starting to turn around a little bit, saying that the Labour government, and we have elections next year, right here, that the Labour government may actually not be as bad as thought for the sterling. Do you have any very early thoughts on that, or not at all?
Yeah, well, first things first, the by-election was in Scotland, so they overturned the SNP, which is the big party over there. Conservatives are the one of the smallest parties, like third party in Scotland. So this was turning over as Scotland. Now the SNP have been in all sorts of problems since Sturgeon and Bod got in trouble. So it's not really a surprise to see Labour taking that over. But yeah, they're gonna love it because it comes on top of the some of the gains they made in the UK or the English by-elections that we heard about. In terms of Labour, this is something that I've been keeping half an eye on. I think I mentioned it a month or so ago, that it does look potentially like the worm is turning in terms of what the press and maybe the markets are going to think about Labour. Okay, Sunak is seemingly running from one fire to another. Okay, nothing he can do is right. Take this. I don't want to get into a big political thing, but take this.
Exactly. I was just going to say. I mean, and I'm seeing all those comments coming in. I know it's Scotland. I know it's a small thing. I just the only thing, and I know about richer and poorer and all those things. We all know about Adderley and thanks Gavin as well for that. No, my question is actually, and I should have formulated it more precisely. Could the Labour report comparably to what historically has been happening to the sterling, and I'm just talking about markets, and could the Labour report be positive for the sterling? That is really my question. Labour government, sorry.
Yes, it can be. I don't think it can be as strong as it would be for a Conservative government. It depends on what policies come out. On one hand, if it's a majority, if Labour win a majority, the market will be happy that it's a settled deal, rather than a hung parliament and having to go through all that uncertainty. So on that front, it will be. Whether it's the things like the city see it as positive, I don't know, because they are seemingly spend what you haven't got, tax everyone to the eyeballs, and it's not. There's no progressive policies in there, so that would potentially still be a negative.
Yeah.
So it's still up in the air, but I think it's perhaps not being seen as bad as it would have been 6 months ago.
Yeah, I mean, in my own view is that any positivity will be short-lived, but that's of course it's food for next year. But it's just I'm just like wondering what you thought about it on the back of those press reports or media, and I know they're biased and whatever, but it's just there and just like having a bit of a very, very early view on could Labour be positive sterling. I think it's if it does in the first couple of weeks or months, it's going to be the fate of next year, I think.
Yeah, you have to know what press outlet is making what story.
Yeah,
because
of course,
the press are biased.
But it's worth having, and I say it's far too early, but it's worth having a little look at it, like feel for it, because markets can sometimes react to stuff, and then all of a sudden wake up saying like, well, perhaps not. That's not what we expected,
Yeah, no, exactly.
That's okay. Let's move on because we have a bigger fish to fry in the immediate.
Yeah, exactly, and definitely we'll keep an eye on the election stuff anyway. Right, let's look at what's coming up, because we've got the NFP coming up and it's double bubble with the old Canadian jobs. And I know Anise is asking what happens potentially with interest rates on the back of these numbers. Right, so let's go through it quickly first. The same scenario as we always look at. We always look first at the headline number. That's going to give you the biggest, earliest shock impact, as always. Then look at the unemployment rate. Is that good or bad? Has it gone up? Has it gone down? Once you get that number, make sure you match it off against the participation rate, because that can affect how the unemployment rate moves. If there's more participation, there can be higher unemployment. A perfect scenario would be the unemployment rate going down while the participation rate goes up, vice versa for a negative. Okay, so you have to match that off always with the participation rate in the unemployment rate. Then we look at the wage numbers. I mainly focus on the year-on-year numbers, which have been sailing pretty good, now turning into real earnings when you've taken away inflation and the like. So that's still a decent positive, but it's still, pretty close. It's not a huge gap opening up there. So those are numbers you've got to look at. So as for the headline, it's pretty obvious that things are slowing down. The chart, you have to go a bit shorter term than that to get rid of the spike. So generally this year, you can see we've had some spike ups, but generally the trend is coming lower and lower and lower. So potentially we're in this soft landing scenario. It still remains a question, are we going to see a bit of a shock like the ADP, where we're expecting 170 and it comes in half of that, or is it going to come in line or whatever? The only way the market's really going to be shocked is if it falls off a cliff. If we do get a magical minus number, that's going to bring the biggest reaction. As far as hikes go, on good data, well, we know that they're pretty much done. Unless there is a real turn in inflation, they're pretty much done. They're keeping their last hike in the back pocket, a little bit of an emergency hike, and the market isn't really worried if they do hike. So even if these numbers suggest another hike or hawkish slant, it's not really going to matter. You're not going to see potential yields, going up another 50 basis points on the back of that. Just on the data, it may grind there if the higher for longer is set another 25 pips higher, but that 25 pips doesn't mean an awful lot in this scenario. So a really strong number. Obviously, you're going to see yields on the dollar react. Can it hold that? That's going to be a different question. You're going to have to match this data then off against your price levels. And we know where our price levels are. For dollar yen, it's up at 150. That's where our magic line is going to be for this data, depending on where we are going into it. For something like euro dollar, we know where it is. It's down. Oh, let's get into a short-term chart. So it's going to be down potentially into 105, or it's going to be down into 104.50 on strong numbers. On the upside, if it's weak numbers, well, that opens the door really to a big volatile move, as I said, if it's a big shocker. So for the data, as I said, know your numbers, know how to react to your numbers, have your price levels ready in advance. Pick the levels where you may want to have a trade against. So if it's a strong dollar move, you know, it's got to get through 104.50 if you get a big move. If it can't get through there, then you know that's become something significant, and then you can react to that. If you're short up here, that's your level you want to think about taking profit. If you're looking for longs and it holds, that's where you want to lean your risk against. So for data, take it all into consideration. Bang, bang, bang. 3 numbers, 4 numbers, judge them, add them up, work out whether it's good, bad, or ugly, and then do that, work that out to your chart. That's how I go through it anyway. As for the loonie numbers or the Canadian numbers, again, this jobs here have been fairly strong, been really robust. So we're looking for potential shocks, but I think there's more a case for stronger numbers here having an impact on the Canadian dollar, because the BOC have been leaning a bit more hawkish, so they may be closer to another hike. Whether it's one or done, we don't know. I think it's a bit more in the balance, this one. So there is more perhaps a reaction you'll see in CAD strength here on strong job numbers than you might see strong numbers in the US, just on the differences between the central banks. But the same thing for that. Watch the employment change, watch the wages numbers, watch the participation rate, unemployment rate, whatever. And in this one, you can see the full-time and part-time switcheroo. A real strong number in an employment gain would be the full-time numbers gaining rather than them all being in part-time. It can be a bit of a revolving door sometimes. One goes up, one goes down. Kay, I know you've got your trading plan for this one and your parameters. What you're going to custom move on?
So first of all, for the US number, so there's I'm trying to keep it very, very simple this afternoon. If it comes in line, and I'm very surprised, by the way, that none of the forecasters is I think the lowest one is 90K or so, which would still be above the what is accepted as the line of job creation and job destruction, which is around 75 to 85K a month. It's less than it was before. Why? I leave that over to the specialists and the propeller heads. But so the lowest forecast is 90K. So this is still just above that line. I think if it comes in line with expectations, the global report, let's say, if you do 170 or more, or even down to 125, 150, but you keep the unemployment rate stable and the participation rate kind of stable, not falling out of bed either. I think what we are seeing here now is a bit of a correction in the dollar, especially in the euro and the sterling, and in the emerging markets, as we have seen as well, that the dollar has ramped higher. So what we're seeing now is a bit of a correction there. I think that if the report comes out, and let's not forget a little look at the revisions as well, because over the past 3 months, all the revisions of the prior reports have been a lower number. Okay, so perhaps the market is going to you will see some stuff on the wire saying like, yeah, it's 185K, but the prior has been revised to 165. It's actually not that good. But still, if it's in line, I think the dollar resumes mildly. Probably it's way higher. But as I said, there's a bit of a risk here because nobody sees the number really collapse, and nor the unemployment rate rise. And we've always have to be ready for the unexpected. And I reckon the biggest move today is going to be on a very bad report. Okay, that's where the real surprise move will be, and the biggest move will be. So be ready for any eventuality. As Ryan already said, it's still a lottery. And the second thing that I'm always looking at is expectations. And again, the options market, the overnight straddles are not, the options market is not really overly excited. We are still within those same ranges as we have seen for the past data, ECB, expectations that we saw. The overnight straddles in the euro dollar are barely around 50, 55 points, 70 points in the dollar yen. So add that and subtract that from the levels where we are now, that means that the market is not expecting huge moves, like give and take a percent will cover the range of the day. So it's going to probably take a surprising number to break those expectations, because mechanically, if you think that euro dollar could move more and you want to buy a straddle, you're going to pay 50 points. So we're at 105.60 in the euro dollar. To make your money back, you need it at 106.10 or at 105.10, right? If that means that in the market, naturally, for people who will have bought this, because there are going to be buyers on such data, you should start to see offers come in the market at 106.10, because above 106.10 you have made your premium back. So that is something, the second thing that I look at. So it does seem that we are going to need a decent variation in the numbers to really make the market go a little bit berserk and take the dollar to one or the other direction. Yeah, it's binary in one way, but I think the bigger move will come on a bad report, right? And as far as yields are concerned, that's where actually this scenario could be thrown out of the water if it's still a decent number, because I've got the impression that on the yields we are just in corrective territory as well. The 10s are still comfortably above the 460, 455 zone. If we get a really bad report, I think that those zones are going to be tested. But if we get a good report, perhaps next week or so, those yields could start to go up again, and perhaps the US 10s go to the 5 and then accelerate the dollar demand. But that's sort of how I look at looking to trade this. And then on the Canada, well, we have to watch oil as well. Even though the Canadian dollar has not suffered a great lot, we have seen dollar CAD move higher over the move down in oil, and now correcting a bit with the rest of the dollars also correcting. But where we have seen the moves is in stuff like CAD yen, euro CAD and stuff. And if you want to take the dollar out of the equation over the US labor report and only look at the Canadian report, then you could actually have a close look at the euro Canada, because there's a bit of a pretty decent, and I'll have a look at that, pretty decent defined levels on each side. You've got your 145 there, that is one, and on the downside there's something going on around 144 and a quarter down to 143.80 or so, and that's your other side. So if you look at getting away from the dollar and trading across could be something you want to look at. I'm going to straight take this question from Cedric. Any foreseen change regarding Aussie dollar and Kiwi? Well, it's always going to be a mover for the dollar, right? In current context, it does appear that the Aussie is trading a tad weaker or actually a bit weaker than the Kiwis. Okay, so if you get a good number for the dollar, I'd say the Aussie may suffer more than the Kiwi, and in turn, if you get a bad number, stuff like the Kiwi can fly, right? So that is my just globally view on those two, how those two could move. All right.
Yeah, I think it's a bit Aussie dollar and Kiwi dollar is a bit like cable and euro dollar in terms of volatility. You know, there's a bit more in Kiwi than there is in Aussie, sort of thing. Then
more liquidity in Aussie than Kiwi.
I mean volatility. Kiwi's going faster than Aussie dollar is. Bit like how cable goes faster than euro dollar.
Yeah, absolutely.
So again, if you want to trade those two, take the dollar out of the equation and trade the speed between the two in something like the cross, Aussie Kiwi cross, just like you might if trade a euro sterling, euro sterling on that basis as well. But I mean, you know, we can cut it up a million ways about what to do over the NFP. The job I always do is I just note my levels. I look at the different pairs, which levels are in play, you know, sort of within 100 pip range of where we are, 50 to 100 pip range of where we are. Some levels I'll look to trade, some levels I won't. You know, we can all find levels in and around the price, but when you've got big data, you've got to take that volatility into consideration. So, you know, here we are, 149. If we stay around there, 150 will be a big consideration on the NFP and a strong number. If it's good, we can't break up there, and the market maybe gets a little nervous about intervention, well, then you use that as a stretch point potentially, and you maybe look at shorts. If we bust through it, well, then that's something different. But then the intervention fee is going to creep up again on us. And the same with the downside, you know, down into, you know, 148s, 147s, that sort of areas, you know, where this intervention stopped, you know, the traffic zone down there, that'll be a consideration on a bad number, because you will find buyers coming in against these lower levels. So yeah, just go whatever pair you want to trade, whatever asset you want to trade, you go through, you pick your levels. I mean, you maybe have three levels either side, and you say, right, these are the ones I'm going to look at. And if the price does anything at those, fine, I'm going to, you know, look to trade that side. It is very difficult to jump on a trade on the data, because by the time you've read it, the time it's taken us 3-5 seconds to read the numbers, judge the numbers, assess the numbers, boom, the market's gone already. So I have to look at the reaction after. What has it done after? What does it mean for central banks? What does it mean for the fundamentals? And thus, what does it mean for which way this price is going? If I like the way the price is going, I may look to look for a dip, for example, and then ride it. Or if I say, no, actually, that's enough, I'll try and counter trade. So yeah, just check your charts, get your levels ready. That's all you can do. Obviously, stocks are going to be hotly watched. You know, S&Ps, we know where the levels are here. We're pretty much bang in the middle, give or take. Everyone's going to be watching 43 level, and everyone's going to be watching the 42 level. So you don't really need to get involved here. You can just wait and pick your levels either side. Yeah, I've got some intermediate levels in the middle here, but, you know, with 3 pips, 4 pips off them going into the NFP, they're not going to count for anything. So ignore your tech close to the price over these events, but don't ignore it after. If you get a move away from it and it comes back, then these levels are going to come into play, likely going to come into play once again. So as I say, stocks, pretty simple, 43 or 42, what do you want to do? I don't know. I don't know what's going on with yields. Have we topped? Have we not? Again, it's going to be a question. This is how you're going to judge stuff, and particularly the dollar. If it's strong data and yields jump, can it get above those highs again? If it can't, if it comes up short, say about the 480, 482s, 83s, can't quite nick a new high, that potentially tells you we've got a top forming up here, early signs of a top forming up here. What you don't want to see is this type of action where you make a high, you pull back, and then you nick another new high, because then that suggests we're not done. What you want to see is this high, come down, can't quite get as high, and then you get a little period of consolidation or a little lower move. So it's going to be, again, key what happens with yields, and the 10 years your go-to price for that one. Can't get above these highs on a good number, well, then you're probably going to see the dollar running into trouble if it's gaining as well. Kay, you've got, I know you've been through quite a bit, so you've got a couple of assets you're going to choose for this one.
Yeah, I'm looking at one. I'm also looking at the clock. Okay, let's go over it quickly. I think dollar Swiss is an important or interesting one, at least. 90, 85. Well, actually, 91 the figure is the level here, and then you take this 90, 80 as a bit of a confirmation level. If it breaks below on a bad report, this one could actually go all the way back down to 89 to this big support from where we started the latest rally. So that's an interesting one to me, especially seeing that the S&P is likely not giving up the ghost yet. On the other hand, if we close above on the daily again, then that could mean that we are finally going to start reaching for those levels. Euro dollar is well, first of all, cable. I mean, cable to me is I'm not going to say simple. Trading currencies is if it would be that simple, we would be I would have 2 yachts and not only one. Cable to me is 122, 121.85. That's where above or below after the numbers hold, and that's probably going to be worth another 120 points. 123, 1020 is still going to be my top end of the latest range. Very close watch. If you look at this, if you get back above, there's a bit of a vacuum there. So if we get a test on a weekend number, this is your zone to watch. And the downside, it's again 120, 80, 90. I would say if it goes below, then I think this low here at 124 is at least going to be retested. But if it's really a strong number and the dollar wrecking ball sets in again, it's probably going to be toast, and we are going to test 120, the big figure. But so this is your range, or my range at least. Euro dollar may be a little less, a little less clear, but top side is I think it goes above 106.40. That means that there might be something wrong with the dollar. For as long as we are above there, below there, this move is still intact. But there's a couple of interesting levels on the shorter term here. Well, actually, not really the shorter term. It's actually on the daily that I have to go back. See this big move that we had from the pandemic, after the pandemic move down. We're still, and this is probably going to be your weekly close, this 106.10, and you can use this 106.30.40 as a kicker if we get back above. But this 38.2, ever since we've been below, we have been unable to retest it. Okay, so that's another one that I'm going to keep a close eye on in the euro dollar. If in turn we get a strong number, we have seen the euro numbers are, how shall I call them, mixed, but they are not great. They are anything but great, especially from the major European engine, Germany. So I do think if we get a good number, that there is a fair chance we're getting back to at least 104.80 around here, that prior low, and perhaps a retest of really the low that we have seen, which was only on Tuesday, not that long ago. That for it. Dollar yen is less obvious, but I want to just touch on, and I'm really going to do it in 1 minute. I want to touch on what we've seen over the past days. We've seen this big move, and I'm still leaving it in the middle, whether it's an intervention or not. But since then, look, 149.30, 149.15, 149.10. Every time we came back there, we've seen quite sizable offers in the market, okay, and subsequently moves lower, moves lower, moves lower. My theory is, and we've been talking about submarines, it's possible, but if I look at what happened in the mix, the ZAR, even stuff like the Canada and things like that, over the sessions when dollar yen went down, I reckon that the trust banks or the trust funds and Mrs. Watanabe have gone out of a lot of their carry trades. And that's why we had those offers coming in the market and pushing down. Yesterday, the rest of the market could do whatever it wanted. Dollar yen was going down. Okay, even euro dollar was very stable. The cable, okay, flying around a little bit, but still stable. But you saw stuff like dollar rand continue to rally, dollar mix continue to rally. Canada has come back since, but it was rallying as well in the process. So I think a lot of and Aussie, by the way, being weaker than the Kiwi is in my opinion also a result of that. So I do think that Japanese or other carry trade accounts have really stepped out of a lot of their carry trade. So that is now, in my opinion, creating a cleaner, perhaps, picture of where we are going to say again, we're talking about 150. Are they going to step up the rhetoric again? Are they going to come in? We don't know. But if it's a good number, I do think we get a retest. If it's a bad number, then perhaps the rest of the market is going to start thinking about, well, okay, risk is perhaps not going to do well, and this could be on an accelerated path lower, perhaps back down to stuff like why not around here, the 147 and a quarter again. It's not that far away, you know, 150 points in dollar yen. We can do them easily, but again, don't forget what the option market is pricing. They don't price a very, very big move. So for that, we are going to need a pretty big variation in the US labor report. For the Canada, I'm leaving the dollar CAD alone, although we are turning around 137 the figure. I think it's a good enough barometer, a bit like the cable around 120, 180, 122, to know whether we are going to end the day above or below here, this 137. It's also the prior high, right? EuroCAD. If you want, as I said, if you want to leave the dollar alone because you don't feel like trading the dollar after the jobs report, there's also crosses being traded, right? And I think this is good enough because look at what we have done. We went to the 50% of this whole move down from August over September when oil was ramping higher. And we've tagged the 50% here. We've also tagged the lows here. So that's around 144, 80, 90, give and take 145, okay? And on the way back down, we stopped. We stopped on any corrections. We stopped around 144 and a quarter. At 144.10, call it 144. This one, I think, could be an interesting one to trade after the Canadian data if you don't want to get involved in the dollar, okay? I'm going to keep a close eye on that one. And I think that's... I'm watching a lot of other stuff.
I'm ringing the bell. I'm ringing the bell.
Taking an hour and a half to do the show.
Yeah, I'm ringing the bell, mate. That's it. Right. Well, the week is done for us at the Flow Show. Thank you to all you wonderful viewers for coming and watching and supporting us. Thank you to K-Man for joining me on the show and giving us all these lovely charts and insight. Have a great rest of your day. Don't go blowing any profits, gambling on a big silly number later on today. Be safe, trade safe, and above all else, have a wonderful weekend. And we shall see you all next week.
Yep, stay safe, folks. Thanks, Ryan. Bye-bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.